Introduction: Pension funds, organization and its working. The traditional family support system has been collapsing over time because of structural changes in the living style, kinship, cultural value, urbanization, globalization, modernization, etc. People no longer expecting support from their children in their old age, which is knocking door for an alternative system of old age financial security. In most of the countries, retirement benefits, medical care and other form of social securities used to come from the government program. But the recent paradigm shift in the demography of population for last 3 decades has increased the dependency ratio, typically defined as the ratio of non-active age to those of active age in a given population, to a large extent increased the life expectancy steadily, which have increased the government financial burden to a greater extent. Hence, assuring pension security is a challenging issue on the part of the government. The alternative system society has developed is pension funds. After studying this module, you shall be able to understand the meaning and scope of pension funds, to learn about the different types of pension funds, to derive the skills to evaluate the performance of the pension portfolio, understand about the regulations of the pension funds. Pension funds. Pension funds are financial intermediaries which manage the pension assets and pay the benefits to the subscriber of the plan. The term manage means management of accumulated funds, their investment and pension payment. Pension funds have grown rapidly in the last 3 decades as primary intermediary for the retirement savings. Pension plan is an agreement to provide financial support to the participant in the time of retirement. These plans are normally sponsored by the employer, but sometimes the labor union also sponsored the plan for union members. Pension funds are one of the fastest growing financial intermediaries, providing number of pension schemes as per the demand of the subscribers. Next, types of pension plan. Pension plans may be categorized in several ways. They could be defined benefit or defined contribution plans, and they could be public pension plan or private pension plan or individual retirement account. Defined benefit plan. Defined benefit plan are those plans where the employer promises to pay a specific periodical sum of money to the employees after retirement. The specific sum of money to be paid to the retired employee is predetermined and the employer is obligated to pay. The payout is determined by considering some factors like years of service rendered by the employee in the organization, last year's salary, retirement age, life expectancy, etc. A practical example could be as follows. Annual payment is equal to 2% of average final 3 years salary into number of years worked. Let's suppose a worker has worked in an organization for 30 years and his final 3 years salary are 20 lakh, 20 lakh 50,000 and 20 lakh 75,000. As per the formula, his annual pension benefit would be 2 upon 100 in bracket 20 lakh plus 20 lakh 50,000 plus 20 lakh 75,000 upon 3 into 30, which is equal to 12 lakh 25,000. The defined benefit plan puts obligation on the part of employer to provide adequate fund to ensure that the promises made to provide specific pension benefit could be achieved. If sufficient amount of funds are set aside for pension payment, then plan is known as fully funded. If fund kept aside is more than the required, the plan is overfunded, and if the fund is less than required, the plan is underfunded. Underfunding could have serious consequences when a firm reaches to situation of bankruptcy. Retiree may not receive their benefit. Next, defined contribution plan. As the name indicates, it is not defined what the pension plan would pay. Rather, defined contribution plan specify that what would be the contribution by the subscriber to the plan. In defined contribution plan, the plan holder contributes a specific periodical amount to the pension funds. In some countries, the employer also contributes some portion of the contribution, or even some places the contribution of employer is equal to the contribution of employee. The pension fund accumulates funds from different plan holders and makes investment of funds. The pension benefit to the subscribers of such plan depends upon the growth and return of the fund invested by the pension fund. In some countries, the subscriber are given the option to choose the securities in the portfolio by the fund managers. Securities in the portfolio are normally equity of companies, government bonds, corporate bonds, etc. Defined contribution plans are becoming popular in number of countries. Chile became the flag runner, followed by Latin America, USA and some European countries. Now most of the countries in the world are in the race to switch their defined benefit system to defined contribution system because of non-sustainability of existing PAYG, pay as you go system, with the increasing government financial burden and dependency ratio. One of the major reasons of switching to defined contribution plan is also the shift in the responsibility of employer to employee in assuring retirement security. India has also switched to the defined contribution system since 2004. Next, public pension plan. Public pension plan are sponsored by the governmental bodies, maybe local government, state government or central government. The traditional pension system of pay as you go, which was operating before the new pension scheme came into operation in India, was public pension plan by nature, where contribution from the present employees being paid as retirement benefit to the current recipient of retirement benefits. In this system, current generation employees would pay the pension benefit of current generation retiree, and future generation employees could be called upon to pay the retirement benefit of current generation employees when they will retire. By looking at the PAYG structure, some started predicting that at some point of time this chain would fail to support the system. Some started thinking that the fund will be inadequate to meet its obligation in future. Because of this, the PAYG losing popularity and augmenting the growth of pre-funded pension plan. In pre-funded pension plan, the employee needs to contribute to the plan for the future income security. Next, private pension plan. Private pension plans are sponsored by private agency, labor union, firms, educational organization, etc. Private pension plans become increasingly popular because of unprecedented growth of MNCs. Next, individual retirement account. As we know, that pension plan offered by the employer entitle substantial amount of tax benefit to the employee, hence self-employed individual or the employee employed in an organization which is not sponsoring pension plan enter into individual retirement plan to enjoy tax benefit and future income security. Next, operation of pension funds. Operating mechanism of a pension fund is depicted. It shows how it accumulates the funds, invests and provides benefits to the plan holders. In the diagram, we could see that both employer and employee contribute to the pension fund, and the pension fund accumulate these funds, uses its expertise and invests them in security markets in different instruments like equity of companies, government bonds, corporate bonds, debenture, mutual funds, treasury bills, money market instrument and others. Sometimes fund also invest in derivative and hedge funds to mitigate the risk. Normally, the magnitude of investment in the long-term government bonds is high. In some countries, the regulator put restriction on investment in some sectors. Also put ceiling in the investment on different class of securities in order to reduce the risk exposure. Normally, exposure to equity is restricted as it is high risk, high return instrument. Some countries' regulator even restricted investment of pension funds to domestic securities market only. Investment in liquid assets such as money market funds is relatively less because pension funds are assumed to be long-term funding. Pension fund derives return from the investment. It could be in the form of interest, dividend or capital growth and distribute the same in form pension benefit. To perform all these managing tasks, pension funds charge small percent of contribution as commission from the plan subscriber. Pension fund managers use two kinds of strategy. First, match funding strategy and second, projective funding. Investment decision in match funding is made on the basis of cash inflow in the future from investment in comparison to cash outflow in pension payment. Both inflow and outflow to be matched, whereas projective funding design the portfolio by accounting expected benefit from the market and interest rate movement. Most fund managers formulate strategy by combining both the strategies. Next, performance of pension fund. Pension fund managers invest major portion of fund in equity of companies, government bonds and corporate bonds. Hence, the performance of fund managers is solely depend on the performance of portfolio which consists of stocks and bonds. Performance of stocks in portfolio. Performance of stocks in the portfolio is function of market condition and management ability of fund managers. It could be expressed as follow. Delta PFP is a function of delta MKT, delta MA. Next, change in market condition. When market condition is favorable, the pension funds perform well in stock portfolio and vice versa. In the recent global financial crisis, pension funds are one of the major losers because of unfavorable markets. Change in management ability. Management abilities also influence the performance of pension funds in various ways. Proper selection of portfolio, efficient management by fund managers could also lead to better performance and cost reduction. Performance of bonds in portfolio. Performance of bonds in the portfolio of pension funds depends upon the interest rate and management abilities of pension fund managers. It could be stated as follows. Delta PFP is a function of delta R, delta MA. Delta PFP is equal to change in pension fund performance. Delta R is equal to change in interest rate. Delta MA is equal to change in management abilities. Change in interest rate. Market interest rate and bond price are inversely related. When interest rate decline, the rate of return decline for the bond holders, and bonds in the portfolios of pension fund perform well. Change in management abilities. Management ability of pension fund could influence the performance of portfolio. Right decision of management of fund in respect bond portfolios with the information available about economy, market and particularly interest rate could generate a relatively stable return for the funds. Evaluation of pension fund performance is not a simple job and there is no specific technique either. But the following technique could be one example. The manager may construct an active portfolio making the mixture of bonds and stocks, and for the purpose of comparison it make a passive investment strategy of investment in index funds which replicates the market movement. The passive portfolio could be the benchmark for comparison which also has the same mixture of bonds and stocks in the index. Let's suppose an active bonds oriented portfolio has bond stock ratio of 70 and 30 which could be compared with the index portfolio benchmark of 70% bonds and 30% stocks in the NSE. Difference in the performance of benchmark portfolio and active portfolio may be because of composition of active portfolio which may have the stocks and bonds whose returns are higher or lower than the index portfolio that may outperform or underperform in relation to the index. A rising interest rate may down the performance active bond portfolio. Normally, the performance of bond and stock in the portfolio are evaluated separately by associating the risk and factors such as market beta for stocks and interest rate for bonds respectively. Next, regulation of pension funds. Regulatory structure of pension fund depends upon the rules and regulations established by the legislature or regulating authority. In USA, the regulation of pension comes under the ERICA, Employment Retirement Income Security Act, and monitoring is in the hand of Department of Labor. In India, the legislature has established a separate statutory body known as PFRDA, Pension Fund Regulatory and Development Authority. It has been assigned the duty of regulation, promotion and development pension architecture in the country. Regulatory body has the duty keeping the system stable and sound. It has also the responsibility of keeping the system safe from the irregularities and frauds by issuing continuous investment guidelines. Next, scope of pension funds. Pension funds are one of the rapidly growing financial intermediaries these days, and rapid pace, globalization and modernized lifestyle also giving fuel to it. With the growth of population, aging and life expectancy, pension fund will grow on the similar line in future. Now, let us summarize. Pension fund is becoming one of the rapidly growing financial intermediaries, operate with objective of providing financial security to the retired individuals. There are basically two types of pension funds, defined contribution and defined contribution plans. Classification can further be extended to public and private pension plans and IRA. Operating mechanism of pension funds is accumulating funds from the subscriber, investing and providing retirement benefits by charging a small percentage of funds as commission. Performance of fund depends upon the long-term performance of portfolios constructed by fund managers. Regulation of pension fund is one of the critical aspects of pension structure. Thank you.